How is market risk measured? Recap. Remember, market risk refers to the fact that the price of your listed debt and equity securities can fall on any given day. They can rise, of course, but that wouldn't be called a risk, right? Now, why would they fall? That's because a whole bunch of investors in the world could be transacting on that security based on what they think of that business, that industry, that economy, interest rates, elections, or the name of the company. Who knows? So how do the finance people measure that risk? They go back in history, the 100-odd years worth of data that they have. In some markets they have less, in some longer. They look at how many times previously have a whole bunch of people felt bad, for how long, and how much have they bid the prices down. Here's the thing, I think the world has changed. There's television, there's phones, there's a whole bunch of technologies. There's also different ways of working. So people may be feeling bad for different reasons. I think people are people, and it's hard to predict sort of collective behavior. It's not like chemistry or physics where you're measuring how the sun or moon move, right? So I think rather than trying to measure through a number, oh, by the way, that number was called value at risk. So rather than measuring that one number, I think it's better to be vaguely right than precisely wrong. So instead of measuring, focus on diversifying away by just putting in a whole bunch of different investments.
Stuff we hope you understand. Everything I've said in this video is educational, not advice. All financial securities, including mutual funds, are subject to market risks. If you don't know what that is or are still scared of it, watch all my videos again.